It's very clear to us, and that's probably our strongest conviction this year, that global investors have been overly exposed to US assets over the past 5 to 10 years, largely on an unhedged FX basis, perhaps because there was no better place to be. I think the current policy shifts that you are seeing in the US, the uncertainty created by these tariff policies, the geopolitical risks that people perceive for right or wrong, are leading people to reconsider the level of US centricity in their allocation. Now, what's striking, in our opinion, is how ignored EM debt has been in the post-COVID recovery of flows to risky assets. So these days, what was a curse for us in the past 3 years is perhaps turning into a blessing. The fact that no one really owns EMD anymore, whether it's hard currency, credit, local currency bonds. We're seeing that everywhere. And so we're in a situation where we truly feel that EM debt is perhaps the most asymmetric asset class around, at least as part of liquid global fixed income, just because it's been so ignored over the past few years. So any minimal reallocation of flows at a time where people are genuinely looking at other opportunities away from the US could benefit EMD. Now, beyond that, it's also a question of what you're buying into EMD. And our strong conviction is that it's also a place where, whether through the highest absolute or real yields you get from local bonds in the past 20 years, the spread opportunity you have in corporates where you're often paid high yield prices for what is actually investment grade risk, or in the superb recovery we've seen in all those frontier stories which were on a near-death experience in 2023 and which have now totally turned around and are delivering on their reform programs. All of that suggests that this is a place where you can still get value for money. So not only the technicals, the lack of ownership makes it very asymmetric on the upside, but also you're buying into value for money, which is largely ignored today. So the global outlook, whether it's geopolitical, US policy moves, are a key consideration. But here we have to be clear about what risks are really serious for EMD. And our conclusion to that is that, yes, this tariff situation in particular is exposing some risk for mostly China and Southeast Asian countries, which are at the forefront of exposure to trade with the US, but also at the receiving end of Chinese imports. China will need to export elsewhere what they can't export to the US. And that's all despite the tariff reprieve that we've seen post-Liberation Day. So we're still left in a worse situation for global trade than we were at the beginning of the year, and we have to accept that. Now, that said, our take on that is that it's going to be worse for the US economy, i.e. both inflationary and growth negative for the US, and still growth negative outside the US, but less so than for the US economy. Or in other terms, what we're seeing as EMD investors is that the place which will be most affected will remain Southeast Asia. But guess what? Southeast Asia these days for EMD investors is no longer a place where you make a lot of money. It's a place which is very well managed, but as such it's low yielding, low volatility, low value at risk. So these days you're making a lot more money elsewhere, especially in countries which are actually not badly treated by the US at this juncture. Beyond that, geopolitical risk, well, this is something we live with, populist governments as well. So as always, markets learn to live with uncertainty. It's a matter of accepting a new regime, and we're already seeing in the behavior of global risky assets that people are able to accept this uncertainty, this series of on-offs on policy risk. The market reaction to the development in Iran in the past few weeks are a case in point. So markets, I think, are increasingly looking at the hard data and trying to see through the noise. And I think that's benefiting EMD as well. So I mentioned value for money before. We're clearly convinced that the corporate space continues to offer a lot of opportunities for income without a commensurate level of risk. If we compare, EM high yield corporates as a group today, they're less levered than both European and US investment grade. Yet, for what looks more like investment grade risk, you're still paid high yield just because a number of EM sovereigns are rated high yield, and as such, rating agencies cannot rate corporates better than their sovereigns. So the arbitrage is there. You're still paid high yield prices for what looks like investment grade risk, even though you can complain that spreads are tighter than they used to be. I guess when that's the case, you have to consider exactly that. What are the commensurate level of risk you're taking for the remuneration you get? And that works in favor of EM. In sovereigns, it's a little more diversifying. We still love a number of frontier stories which are still accruing and delivering on their reform program. So Argentina, Ecuador, Egypt, despite the proximity of the Middle East situation, continues to be well supported and delivering on their reform credentials, a stable currency. Turkey remains an opportunity for us on the local currency front. You paid 48% for a currency that depreciates only 20-25%. And we also like a number of local bond markets, just because inflation is nowhere to be seen in EMs. Central banks have done a superb job in managing that. But we're also in a weak dollar environment, which creates both opportunities for higher FX values versus the US dollar, which is what we've been seeing since the beginning of the year. So the local currency space is up 11% already, and we think that will continue. And as long as we remain in a weak-ish dollar environment, that creates a lot of policy flexibility for EM central banks. So even if growth will moderate, not dramatically so, but will moderate across EMs, central banks are in a key position to accompany that growth downside with potential rate cuts. And guess what? Absolute level of local yields are still near 20-year highs ex-Asia. So we always have to segregate Asia from the pack. But ex-Asia, we're still near 20-year highs in absolute yield levels for local bonds, and even more so in real yield terms, because inflation is non-existent in most countries.